Welcome. In this video, will Zbcn coin boom again? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. The concept of an ascending curve is one of the most important structures in technical analysis that shows the price is in an upward trend. When the price consistently makes higher lows and higher highs over time, these movements form a curve on the chart that arches upward. This curve is actually the clearest sign that buyers are strong in the market, because every time the price pulls back, it reacts from a point above the previous low and starts moving upward again. Thus, the path of the price resembles a line curving upward. For this reason, such ascending curves are considered very important, because as long as the price stays above this curve, it shows that the trend is maintaining its strength and the probability of the uptrend continuing is high. Now, when we say this curve should not be broken, what is really meant is that the trend should not be disrupted. If the price falls below this curve, meaning buyers are starting to lose strength, the uptrend becomes threatened. Most investors rely on such ascending curves and believe that as long as the price stays above the curve, the long-term uptrend will continue. That is why protecting this curve is also psychologically very important. Because as long as the price stays above this curve, market confidence increases, buying appetite continues, and the uptrend carries on strongly. When the curve is broken, this sense of security collapses. Some buyers prefer to take profits, while sellers increase the pressure, and the price begins to pull back more quickly. For this reason, investors who do technical analysis always watch these kinds of curves closely and track whether the price falls below this line. If the price tests the curve but does not break it, this proves that buyers are strong and is often followed by a sharp upward move. Because support levels are where the market engages in buying, and the ascending curve is the clearest example of this support. Ascending curves usually appear at the beginning or in the middle of a bull trend. After moving sideways for a certain period, the price begins to arch upward as buyers gain strength. Over time, this curve becomes more noticeable and can be easily seen by market participants. At this point, it becomes extremely critical for the price to stay above the curve, because investors use the curve almost like a roadmap. As the price moves further away from the curve, the market becomes more optimistic. As it gets closer to the curve, the market becomes cautious but still hopeful. Not breaking such an ascending curve is very important not only for short-term price movements, but also for maintaining the long-term trend. Because in technical analysis, trends are the structures investors trust the most. The phrase, "trend is your friend," is not said for nothing. If a trend is upward, investors assume it will continue and position themselves accordingly. An ascending curve is one of the clearest visual reflections of this trend. Therefore, as long as the price does not break the curve, buyers remain strong and the market tends to continue upward. When explaining why the ascending curve should not be broken, the psychological aspect should not be overlooked, because financial markets are not only about mathematical models, they are also a reflection of human behavior. Since most investors buy relying on ascending curves, if this curve is broken, panic selling may begin. This can cause the price to drop quickly. However, if the price bounces off the curve and continues upward, confidence increases and more investors enter the market. This in turn causes the price to rise even more strongly. As long as the curve is not broken, the step-by-step upward movement of the price is a clear sign that buyers are steering the market. During this process, every pullback is actually seen as an opportunity, because when the price approaches the curve, buyers immediately step in and push the price upward. As this cycle continues, the uptrend becomes stronger and it becomes easier for the price to reach higher levels. From a technical perspective, such ascending curves often act like dynamic support lines. In other words, the price does not rest on a fixed line, but on a curve that constantly moves upward. This shows that the uptrend progresses not only with a horizontal support, but with constantly increasing support strength. For this reason, as long as the curve is not broken, the upward momentum in the market continues to remain strong. In some cases, the price may pull back several times to test this curve. This is normal, because no price movement goes upward forever. However, the important point is whether the price reacts upward again after these tests. If the price finds support at the curve and turns upward each time, this is a sign that the uptrend is healthy and strong. In conclusion, if there is such an ascending curve and the price continues to stay above it, a strong sense of confidence is built to preserve the trend. This curve must not be broken, because once it is broken, the uptrend is damaged and the market may shift direction under the control of sellers. However, if the price bounces from the curve and continues upward, this may mark the beginning of an even stronger rise. This is the main reason why investors focus on such curves, because if the ascending curve is preserved, the uptrend is solid. If it is broken, the trend is lost. But we can't make a decision just based on the curve. So let's also look at the other metrics. Stay tuned.
The concept of a bearish order block is an extremely important structure in technical analysis, especially based on the smart money theory. At the core of this concept lies the traces left in the market by major players, such as institutional investors, banks, or funds. A bearish order block refers to the area where the price previously reversed under strong selling pressure and where sellers entered the market heavily. These areas are usually zones where large sell orders are concentrated, and when the price approaches them, the likelihood of sellers stepping in again is high. Therefore, investors always see bearish order blocks as potential resistance zones. The presence of such a bearish order block above the price indicates that the price faces a significant obstacle as it rises. Now, when we say that the price needs to test this bearish order block, it actually means the price must touch this strong resistance level to test how strong the sellers in the market are. Because in technical analysis, no resistance or support level breaks with a single touch. The market tests these levels, gauges the strength, and then either pulls back or gathers momentum to break them. From this perspective, bearish order blocks are extremely critical levels. When the price reaches them, it usually encounters selling pressure at first and pulls back somewhat. But later, if the buyers are strong enough, the price recovers and breaks the block. The breaking of a bearish order block is of great importance for the continuation of the trend, because when this block is broken, it shows that buyers have gained the upper hand over sellers in the market. This indicates not only a short-term rise, but also that the trend may move toward bigger targets. One of the strongest barriers in front of the price is thus eliminated. That's why the price testing and then breaking the bearish order block is one of the most critical steps that opens the way for a long-term uptrend. At this point, the most important thing to note is that it is difficult for the price to break this block in a single attempt. Most of the time, the price touches this level several times, with sellers stepping in each time to push it down. However, this process is actually beneficial for buyers to gather strength, because with each test, weak sellers are eliminated from the market and eventually buyers gain enough strength to break the block. This process is called accumulation, or a power-gathering phase in technical analysis. In other words, it is normal for the price to test the block several times before breaking it, and this actually increases the likelihood of a breakout. Bearish order blocks are also psychological barriers. A large portion of investors prefer to sell when they see these zones, because since the price fell sharply from there in the past, they believe the same thing could happen again. However, if buyers overcome this psychological pressure and push the price upward, then breaking this zone creates even greater confidence, because investors now see that the zone can no longer be defended by sellers and they buy more boldly. This leads to a faster rise in price. When a bearish order block is broken, not only is a resistance eliminated, but a new support level is also formed. Because once the price moves above the block, if it pulls back, that same area starts working as a support where buyers step in. This situation is called support-resistance flip in technical analysis, and is one of the key signs that the trend is progressing healthily. In other words, when the price breaks above the block, sellers weaken and buyers gain a new stronghold. The breaking of bearish order blocks usually occurs along with an increase in volume, because strong resistances require significant buying power to be overcome. If the price breaks the block with low volume, the breakout may be false and the price could turn back down. However, a breakout with high volume is much more reliable and is a strong sign that the trend will continue. That's why investors analyzing bearish order blocks pay attention not only to price action, but also to volume. The breaking of bearish order blocks is also a major psychological turning point for the market, because these blocks are usually imprinted in investors' minds as selling zones. However, when the price breaks this area, investors' perception changes. The place that was once for selling now becomes a buying opportunity. This change in perception can completely alter the direction of the market and open the door to much larger rallies. In conclusion, if there is a bearish order block above the price, this area is one of the biggest obstacles in front of the trend. The price needs to test this block because the market cannot move upward without testing the strength of the sellers in this area. If the price tests the block, pulls back a few times but eventually manages to break it, this is an extremely positive sign for the uptrend. Because in this case, the biggest obstacle in front of the price is removed and the way for further rises is cleared. That's why bearish order blocks must always be monitored carefully, and the reactions of the price in these areas should be closely
closely watched, because these reactions are among the most critical indicators that determine the future of the trend.
The Bollinger Band is one of the most popular technical analysis tools used to measure market volatility and predict potential future movements. Developed by John Bollinger, this indicator consists of a simple moving average with standard deviation-based bands placed above and below it. Price movements fluctuate within these bands, and the width or narrowness of the bands indicates market volatility. The expansion of the bands shows that the price is highly volatile, while the narrowing indicates that the price is consolidating. The beginning of a narrowing signals to most investors that a very important move in the market is approaching. Because the market cannot stay calm for long, low volatility is always a precursor to high volatility. The narrowing of the bands actually shows that energy is accumulating in the market. This can be compared to pulling a bowstring back. The more the bow is pulled, the stronger it shoots forward when released. The market behaves in the same way. When the price stays within a narrow range for a long time, it appears as if a balance has formed between buyers and sellers. However, when this balance breaks, the price moves very quickly and strongly in its new direction. That's why narrowing in the Bollinger Band is often the first sign of major breakouts. Narrowing periods carry both opportunity and risk for investors. They offer opportunity because the breakouts following these narrowings often present great profit potential. They carry risk because the direction of the breakout cannot be known with certainty in advance. The price may break upward or downward. At this point, the analyses investors perform and the additional indicators they use become decisive. When narrowing begins in the Bollinger Band, the price usually moves with increasingly smaller candles. A horizontal consolidation is observed, and the bands move closer together. This process can sometimes last a few days or even several weeks. However, the longer the narrowing lasts, the stronger the breakout that follows is expected to be, because the patience of market participants runs out, and even a small spark can trigger a major move. This situation is especially common in the cryptocurrency markets. Since volatility is already high in these markets, narrowing periods make the probability of a breakout much stronger. If the breakout after narrowing is upward, the price quickly moves toward the upper band and often breaks outside the band. This shows that buyers are dominant in the market. In such a case, the uptrend is very strong, and investors increase their positions, giving momentum to the price. If the breakout is downward, the price breaks the lower band and sharp declines occur. These declines often combined with panic selling, causing the price to drop much lower in a short period. When the Bollinger Band narrows, the most important thing investors pay attention to is volume, because understanding the direction of the breakout is easier with volume. If volume starts increasing while the price moves within the narrow band, it usually means preparation for an upward breakout. However, if volume is decreasing, the risk of a downward breakout increases. Upward breakouts that occur without volume are often not sustainable, and the price usually falls back into the narrow band. From a psychological perspective, narrowing periods in the Bollinger Band are a process that tests investors' patience, because the price staying in a narrow range for a long time creates boredom and impatience among market participants. Many investors consider closing their positions during such times. However, those who remain patient can catch big opportunities, because once the breakout begins, the price moves very fast, and it's important not to miss the chance. In other words, a patient investor during narrowing has the potential for large profits once the breakout starts. Looking at historical examples, it is seen that very strong trends often begin after Bollinger Band narrowings. Especially in the cryptocurrency market, major uptrends have usually followed a long narrowing process. For example, Bitcoin has experienced many sharp upward breakouts after narrowing periods in the past. Similarly, in some altcoins, band narrowings have been the harbinger of major declines. This is one of the factors that increases the reliability of the Bollinger Band. Another important point is the movement of the price within the bands during narrowing. If the price moves more toward the upper band within the narrow range, this shows that the probability of an upward breakout is higher. If it moves closer to the lower band, then the probability of a downward breakout increases. In other words, the position of the price during the narrowing period gives important clues to the investor. Breakouts after narrowing usually determine the long-term direction of the trend. That is, the move starting with the narrowing is often not just a short-term fluctuation, but also the beginning of a long-term trend. That's why narrowings are considered extremely critical in technical analysis. The most important thing investors should do during these periods is not to neglect risk management, because since the direction of the breakout cannot be known in advance, protective methods such as stop loss should always be used. In conclusion, if narrowing has begun in the Bollinger Band, it shows that the market is in silence and a major move is approaching. While it is not possible to predict the direction of this move with certainty, factors like volume, momentum indicators, and the position of the price within the band give investors clues. However, regardless of direction, breakouts after narrowing are usually very strong and can fundamentally change the course of the market. Therefore, investors should be cautious during these periods and closely monitor the market to avoid missing opportunities.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.